Stakeholders in the stock market, an overview. The stock market is a dynamic and interconnected system that serves as a platform for buying and selling securities, such as stocks, bonds, and other financial instruments. A range of stakeholders interacts with the stock market, each with their own unique role, interests, and influence. These stakeholders can be broadly categorized into several groups, each playing a crucial part in the functioning of the market. This essay outlines the key stakeholders in the stock market, discussing their roles, interests, and impact on the market. 1. Investors. Investors are the central stakeholders in the stock market, as they buy and sell securities for the purpose of earning returns on their investments. They can be classified into two main categories: retail investors. These are individual investors who trade in small quantities of stocks, typically for personal financial goals, such as saving for retirement, education, or building wealth. Retail investors often use brokerage accounts and are generally less knowledgeable about the complexities of the stock market compared to institutional investors. Institutional investors. These include large organizations such as pension funds, mutual funds, insurance companies, hedge funds, and endowments. Institutional investors typically trade in large volumes and often have significant influence over market movements. Their investment strategies are often more sophisticated and can involve complex financial instruments. Investors are primarily motivated by the potential for capital appreciation, dividend income, and diversification of their portfolios. Their activities provide liquidity to the market, helping to ensure that shares are bought and sold efficiently. 2. Companies, issuers. Companies that issue stocks are also key stakeholders in the stock market. When a company decides to go public, it does so by issuing shares in an initial public offering, IPO. The company benefits from the proceeds raised through the sale of shares, which can be used to fund expansion, pay off debt, or pursue other strategic initiatives. There are different types of companies involved in the stock market: publicly traded companies. These companies have issued shares that are traded on stock exchanges. They are subject to regulatory oversight and must adhere to transparency and disclosure requirements. These companies often rely on the stock market to raise capital for growth and development. Privately held companies. Some companies may choose to stay private or become privately held after an IPO. They may still be affected by the stock market due to the pricing of their shares in secondary market transactions, or in the case of future IPOs or mergers and acquisitions, M&As. The performance of a company in the stock market directly impacts its valuation, reputation, and ability to raise additional capital. Positive stock performance can attract more investors, while poor performance can lead to decreased investor confidence. 3. Stock exchanges. Stock exchanges are the platforms on which the buying and selling of securities occur. The role of stock exchanges is to provide a transparent and regulated marketplace for the trading of financial assets. Some of the major global stock exchanges include the New York Stock Exchange, NYSE, Nasdaq, London Stock Exchange, LSE, and Tokyo Stock Exchange, TSE. The exchanges provide the infrastructure for transactions, enforce trading rules, and ensure that market participants follow regulations. They also facilitate the price discovery process, as the prices of stocks are determined through the interaction of buyers and sellers in the open market. Exchanges can also have an impact on market liquidity, which affects the ease with which investors can buy or sell securities. Their operations are influenced by technological advancements, regulatory changes, and global economic conditions. 4. Regulatory bodies. Regulatory bodies play an essential role in ensuring the integrity and stability of the stock market. These organizations are responsible for creating and enforcing the rules that govern the market, preventing fraud, manipulation, and unfair practices. Some of the key regulatory bodies in the stock market include Securities and Exchange Commission, SEC. In the United States, the SEC is the primary regulatory authority overseeing the securities industry. The SEC enforces securities laws, monitors trading activities, and ensures that investors are provided with accurate and timely information. Financial Industry Regulatory Authority, FINRA. This is a non-governmental organization that regulates brokerage firms and their registered representatives. It ensures that brokers and other market participants adhere to ethical standards and comply with industry regulations. Other global regulators. Other countries have their own regulatory bodies, such as the Financial Conduct Authority, FCA, in the UK, the Securities and Exchange Board of India, SEBI, and the Australian Securities and Investments Commission, ASIC. These bodies are responsible for overseeing the financial markets within their respective jurisdictions. Regulatory bodies are critical for maintaining investor confidence and ensuring that the stock market functions in a fair and transparent manner. Their actions can impact the operations of stock exchanges, companies, and investors. 5. Brokers and dealers. Brokers and dealers are intermediaries who facilitate the buying and selling of securities on behalf of investors. They play an essential role in the stock market by ensuring that transactions are executed efficiently. There are two main types of market participants in this category: brokers. A broker acts as an intermediary between the investor and the stock exchange. They help investors buy and sell stocks, typically charging a commission or fee for their services. Brokers can operate on behalf of retail investors, institutional clients, or both. Full-service brokers provide a range of services, including research, advice, and portfolio management, while discount brokers focus on facilitating transactions with lower fees. Dealers. Dealers, on the other hand, buy and sell securities for their own account. They may maintain inventories of stocks and other financial instruments and provide liquidity to the market. Dealers earn profits from the difference between the price they buy securities for and the price they sell them at, the bid-ask spread. Brokers and dealers help ensure that investors have access to the stock market and that trades are executed efficiently. They are also subject to regulatory oversight to ensure that their practices are fair and transparent. 6. Market makers. Market makers are financial institutions or individuals who provide liquidity to the stock market by continuously buying and selling specific securities. They help ensure that there is a market for securities at any given time, even if there is not an immediate buyer or seller for those securities. Market makers profit by buying securities at a lower price and selling them at a higher price. In doing so, they reduce the bid-ask spread and enhance the efficiency of the market. In some exchanges, market makers are obligated to maintain a certain level of activity and liquidity for specific stocks. 7. Analysts and financial advisors. Analysts and financial